Welcome. It's nice having you. I'm Nathan Krampe, a wealth advisor that specializes in retirement planning for business owners and high-income professionals. Now, what we do here is help to build your wealth over the years and do the correct strategies for some of your retirement planning. Now, what I want to do is talk a lot about some of those strategies here, but I want to actually take a step back and talk about Jack Whittaker. Now, this name may not be familiar to you, but his story is one that happens a lot now, and it actually did make headlines across the world when it happened. You see, Jack wasn't always wealthy, but he had a great income stream. He had built a successful contracting company from the ground up in West Virginia, and it reached over $1 million in earnings on just a yearly basis. So he was doing a great job, and he employed 100 people, and he was known as being a generous employer and a philanthropist in his community. So there was a lot here. But in 2002, Jack did something that would be considered the ultimate financial jackpot. He won the Powerball lottery, and it was worth $314 million at the time. And it was the largest payout that was undivided in the lottery history. So, after taxes, he took home about $113 million in a lump sum. Now, with Jack, he was already a millionaire before winning. He had had a lot of money that he had been saving, and with his business acumen, he really actually was doing a great job because he understood money and he'd been very successful. But what most people would assume is that his business background, this enormous windfall, he would be set up for life. But within 4 years, Jack was broke. Now, how does someone go from having over $100 million to financial ruin? Well, the same way that you as a high income earner may be thinking about and worried about, and it's just on a more dramatic scale. You see, Jack's story is extreme, but it illustrates something that I've seen too often with many high-income earners, that they start too late in their careers. They make a lot of money, but they don't really have that translate into long-term financial security. And today I want to break down some ways that you can be working with and thinking about, especially if you make over $250,000 a year and are still struggling to be comfortable and making money to put aside for retirement. I want you to be thinking about some of these strategies that you can implement to make sure that you're not just another statistic. Well, what happened to Jack Whittaker? Well, the problem really started immediately after his windfall because he didn't have the proper financial basis and background and boundaries with his planning. He began splurging on luxury items and properties. He gave away millions to family members and friends, his church. He started a charitable foundation, and he didn't have proper governance though. He gave a large amounts away. He had over $800,000 in his car that was stolen. He developed a gambling habit, an alcohol problem, and many lawsuits. And in 2006, he actually told reporters that he had wished he had torn up that ticket. And yes, by 2007, his bank accounts were pretty much empty, and that money should have lasted many generations, but it was gone in less than 5 years. And what was particularly tragic is that Jack already had the income to retire well before he had the lottery windfall. You see, he had applied some financial principles to his original income, but he never actually did that with the lottery ticket as well. Now, yes, we're talking about lottery tickets with him and the different elements, but I know you're thinking that this is not going to be you because you're not going to win the lottery and you don't have a gambling problem. That's fine, and I don't want you to have that. But what I am saying is that the high income earners, especially you, may face severe challenges that will lead to similar outcomes sometimes in the future. So a couple of those things that we look at here are some of the lifestyle inflation elements that happen. because as your income grows, your spending tends to grow with it. And the bigger the house, the luxury cars, the exclusive vacations, and before you know it, you're still spending everything that you make, even though you have a higher income. Well, also, because of the higher income, you have a higher tax burden. And if you're making over $230,000, the $250,000 range of income, your brackets really start to go up. And we can get as high as 37%, and that may continue to keep increasing, especially if we have your state taxes on top of that. And without proper planning, taxes can really eat away a significant portion of your wealth. Well, then we also have a limited access to your tax advantage accounts. And because many different accounts are for lower income individuals. So as a high earner, you actually have limits on how much you can put into your retirement plans. Well, for a Roth IRA, a contribution there phases out at a much lower income for you for a single, and we're talking right around that $230,000, $240,000 for a married couple. So you may actually be over the levels to put into the Roth IRAs on a yearly basis. Well, then you also have delayed or inconsistent savings patterns as well. And I know that's something that changes through the years as things crop up, but you actually may be like many other high income earners, like doctors and lawyers and other owners that really earn substantial incomes, but then with education burdens, with building, with all the things that they have that they need to be putting money towards, or even just building your practice or your firm, it gives you less time to benefit from the compounding growth that's out there with putting money aside today for the future. Well, another one is then that I see this a lot, a false sense of security. And it's just like Jack, that many high income earners assume that their current income will translate to long-term wealth. But that's a dangerous assumption that leads to an inadequate retirement plan. So let's go back to Jack. Because as he was in interviews later on, he reflected on what he did wrong, and despite being a successful businessman, he hadn't developed a financial plan and then a strategy, nor did he have the skills needed to really help and sustain his new level of wealth, because he hadn't created the structures to protect his assets. He hadn't planned for the psychological impact of the sudden wealth. And when he passed away in 2020, he was living on a modest home, having lost nearly everything, including his health, his reputation, his relationships. And yes, it was heartbreaking. And that's Jack's story. That's not yours, and doesn't have to be yours. And it didn't even have to happen to him, because he could have had that proper planning and the discipline. But Jack's original income would have been more than enough to build lasting wealth for generations. Here's what we can do. Here's some things I want you to consider, how you can be avoiding similar fates, even on a smaller scale. We're not talking that we have to have millions of dollars of income, but even at $250,000 of income, or a little bit more than that, you're still needing a lot of different ideas and strategies and tips on how to do this well. So here are some that I've put together for you that you can be working on and considering. First one, max out your tax advantage accounts. So like I said before, there are some limits here on your amounts that you can be putting away based upon your income. But we can put away as much as we can. So that's called maximizing your tax advantage savings plans. Like contributing to your 401k. You can do $23,500 in 2025. Plus, if you're over the age 50, an additional $7,500 for your catch-up. Well, then we can also have your employer match that's going into there as well. So we can get up to $70,000 going into your 401k plan. And we can also use backdoor Roth IRA contributions to really try to add some money into your tax-free plans. And I want you to also consider what would be called a mega backdoor Roth. And this is if your employer plan allows it as well. So as a business owner, you can write this into your plans so that you have the ability to do that. If you are working for another company, just check the documents. They may actually allow for these types of things happen. Well, then the second thing that you can do is leverage your health savings account, because this can really be a stealth retirement account as well. You see, your health savings accounts, your HSAs, they offer triple tax advantages. Well, they have the tax deductibility contributions that you can have. They have tax-free growth and tax-free withdrawals for qualified medical expenses after the age of 65. You can also withdraw for any purpose, paying for regular income tax like a traditional IRA as well. So there's a lot that we can be doing with your HSA plans. Well, then we also want to be considering your cash balance plans as well. And as a business owner, these defined benefit plans can really allow you to contribute over $280,000 annually, depending on your age. And then they can provide significant tax deductions while building a substantial retirement account. Then, fourth thing that I want you to consider is really diversifying across your tax buckets. Now, we have 3 different tax buckets that we can be working on. Your pre-tax, this is the ones like your traditional IRAs, your SEP IRAs, even your Roth accounts and Roth 401ks and your backdoor Roth IRAs. All of those are great ways to be putting money into the plan that will grow. Now, I did mention the Roth accounts there, the Roth IRA, the Roth 401k, and yes, those are tax advantaged accounts. Those are ones that will be growing without tax on a yearly basis. Now, we also have the tax-free accounts as well, and those are the ones that really can help you to, well, make sure that your money grows tax-free. And that's what the Roth is for. That's those pieces. So yes, they grow in a tax-advantaged way that we don't get taxed on a yearly basis, but now we can actually take a look at it and pull money out without having any more tax owed. So that's the second bucket that we need to be considering and putting money into as well. Then we have the third bucket. And I call this your tax me now bucket, is really the best way to describe it, because this is your taxable brokerage accounts. They may not have tax efficiency within the account, but we can make sure we have tax efficient investments that can help give you that flexibility in retirement as well. So those are a couple of good ideas. I have another one here for you as well. Explore your specialized vehicles that you have for high income earners. And these are different elements like your non-qualified deferred compensation plans that you may have at work, because we can be putting money into these plans that may actually be growing in a tax-deferred manner. Then we have municipal bonds that can provide some tax-free income. And if we structure those correctly, we may even be able to avoid AMT. Well, we can also use some life insurance. And this is another great tool that a lot of times is overlooked, because we can be putting money aside into life insurance, especially one that has a cash balance plan that grows, or not a cash balance plan, but a cash value plan that will grow with it. And what can happen there is that we can be having that grow tax-free, especially if we're going to be using it for life insurance. But if you take a loan out in the future, remember that yes, at some time in the future, those loans will be repaid, but it could also, in the meantime, be a great source of tax-free retirement income as you're taking the loans out of those policies. Then we have a deferred income annuity. And those are different elements I understand you may or may not want, but it's just another tool to provide some income streams to make sure that money lasts throughout all of your retirement. And for your spouse as well, making sure we can pass on more and more to your kids and other elements for legacy. Well, then we can also consider your location for the assets. So if you have inefficient investments, ones that pay a lot of dividends, a lot of different elements, we want to make sure that those are going to be placed into your IRA accounts, your tax advantaged accounts. And then the ones that are more efficient, we can place into your taxable accounts. And this will help boost your returns. And sometimes we can do 0.5%, 0.75% returns annually because we're not having to pay tax on that. So it'd be an additional amount that we could possibly get above and beyond just a normal amount of growth, just because we figured out the best place to hold that. Number 7 is that we want to develop an alternative income stream. You see, the rental properties that you have, other management that are there can provide some passive income. Even the businesses that you have, whether they're providing royalties or you have some intellectual property, they can also provide some ongoing income streams, so we don't actually have to take as much out of your other accounts. And that can be actually really helpful. And like I said before, don't overlook your healthcare planning, because the medical costs are one of the largest expenses that you may actually have in retirement. And if we take a look at some of the long-term care planning, some of the different hybrid policies that are out there, we can actually put a budget in place and potentially even lower what you pay for not only your premiums, but also coverage in the future. So that's some great tools that you can be looking into. I also want to give you a couple of common mistakes that you can avoid as well. This is something that happens to a lot of high income earners. First of all, they assume that their income equals their wealth. And that's where, I know you know this, I know it's conceptual for you that your income is not your wealth, but your wealth is what you keep and grow. And it's not what you earn. And there are many others that are out there that live paycheck to paycheck, despite their substantial incomes. And because you're watching this, I know that's not you, but also know that the more you put away, the better off you can be as well. Second thing here is that I see this happen a lot is the over-reliance on your employer stock. So this is where we have a lot that comes to as working for a company that has stock that they put into your 401k or that they give you as part of your stock purchase plan. This is where many executives that make millions of dollars and they may have millions of shares of company stock, they actually do not have enough diversification. And I can see this happen multiple times. I mean, we have the Enron stories and even GE, but we have other stories that are out there as well that we have wealth that is destroyed overnight just by an event. And take even United Health. They had the passing of their CEO just because of some civil unrest. Well, those things can change the trajectory of the stock price overnight. And when we have stable companies, they can still falter. And that, I don't want to have that hurt you. Well, we can also ignore some withdrawal strategies as well. And it's not about just the accumulation. It's about how you withdraw efficiently, the tax efficient withdrawals. Because if we lose 30 to 40% to taxes, that's not what we want to do. So it's picking and choosing and making a plan to withdraw from as well. Fourth thing then, it's not just about adjusting your lifestyle and the expectations. You see many high earners expect to maintain their pre-retirement lifestyle. And this may be you, but if you haven't saved accordingly, the math just may not work out. And that's where it leads us to our last one here. Many individuals, especially in retirement, want to try to time the markets because as you have shifted from a high-income professional to now having a little bit more free time, a lot of times you like to take this on yourself. And you can make some big mistakes in some timing, especially if we're not being consistent with making sure we're invested into the correct areas at the correct time. So those are some elements there that I want you to consider and what you should be doing. You should be mapping out your current income and some of your savings rate, and then your tax situation, and that alone can help you to maximize your opportunities. Then I want you to develop a plan, a clear vision for your retirement. And what lifestyle do you want? How much will it cost? And what do you want to achieve? And then create a comprehensive plan to address that. And all the tax efficiencies that are out there, the estate planning, the healthcare, even some of your risk management. And again, if you earn over $250,000 a year, having this plan in place will likely help you to save hundreds of thousands of dollars just by making sure that we're not unjustly having that money taken in lawsuits or taxes or other elements, because we don't want you to leave that on the table. And don't be like Jack Whittaker, having all the income in the world but no lasting financial security. So with it, as you have any questions, feel free to reach out. I look forward to seeing you again. There are many different videos here. Please like this video below, reply to us with a comment, and let us know what your questions are, and we'd be happy to sit down for a complimentary consultation as well. And subscribe to our channel to keep informed of new videos.